Welcome back. All during July, we're talking about retirement here on our Money Monday segment and making sure you are prepared for the future. We're joined today by Matt Meese. He's the sales manager for investment and insurance with Mountain America Credit Union. All right, Matt, I got to ask because it may seem obvious, but tell us why planning for retirement, it's so important. We hear about it all the time. We're inundated with the commercials, but why is it so important that we start planning and start planning early?
Yeah, it's so important because the financial landscape has changed dramatically in the last few years. Really, pensions and other guaranteed sources of income are not as common as they used to be. And then also Social Security is in question. So a lot of that has placed the responsibility back on us as individuals to save for retirement. And
even the things that are there are not necessarily guaranteed when you think about the Social Security. And things can frankly change with your company. They can do away with pensions and things like that too.
Yep.
Last week we talked about 401ks and IRAs. So easy question here. What do you do if you don't have one out there, a 401k right now? Should you panic? If you're, say, in your 40s or maybe getting close to the age where you want to start thinking about getting out of the workforce?
Well, the 401k is the most common type of retirement savings account. And even though that's the most common, not everybody has a 401k. So to answer your question, don't panic. But yes, do plan. And so the 401k, even though it's employer-sponsored, some people may be self-employed, may be working for a small employer, and don't have access to a 401k. But that's the time to look at other options.
I think of small business owners and maybe people who are employed on their own. What's the best way to get started if you're not working for a large company and you don't have like an employer match type program?
The first is to open an IRA, an individual retirement account. And as we spoke last week, that IRA, you can contribute up to $5,500 annually. If you're over 50, you can contribute $6,500. But in a traditional or a Roth IRA, you're committing dollars to that long-term retirement goal anytime after 59 and a half. So with a traditional and Roth, the difference is really when do I pay the taxes. With a traditional, I defer until sometime after 59 and a half. With a Roth, it's just the opposite. You pay the taxes today, and then don't pay any taxes after 59 and a half.
I always get nervous when I think about that. For even myself, you know, it's like, okay, when is the money going to be worth more, now or later, depending on when you pay the taxes? So,
right.
Yeah, it's a tough decision, I guess, you have to make.
It is, and it's a tax decision, really. What, do I want to take the pain today, or do I want to defer it later? And everybody's situation is a little bit different. So I think that's, again, where you'd want to look at other options and just really explore what fits my situation best.
All right, Matt Meese here from Mountain America Credit Union. More information at macu.com if you'd like to check it out. Tons of resources, guys, and we talk about it every Monday here on the Browser 5.0. Thanks, Matt. Good to see you, buddy. All right, over to you, Lori.
Okay, here's